All right. What we're going to talk about now is probably the simplest trading system you can imagine for options. It is based, well, I developed it out of frustration. I used to spend a whole lot of time analyzing stuff. I mean, a whole lot of time. And it eventually got to the point where all I was doing was analysis and not able to trade because I had to spend so much time doing the analysis. I didn't have any time. Analysis paralysis, right? I remember it was back in 1996 or 97. It was winter of 97. And I was watching CNBC one afternoon, and I heard this guy talk about, in the afternoon report, oh, the market looks really strong today. Advancing issues are beating declining issues. Anybody ever hear that phrase, something like that? It's like, oh, the market's really strong. Well, I also heard this one phrase during the 15 years or whatever it was at the time that I've been in the business. The trend is your friend. Anybody else ever hear trend is your friend? So it's like, okay, trend is your friend. Market looks really strong today because advancers are beating decliners. So I said, I'm going to do something really simple. I've got a database of advancing issues compared to declining issues and see, does the market have a tendency to go up after advancing issues beat declining issues? Because if the trend is your friend, that means market goes up, market should continue to go up, right? Because it's an uptrend. So if the trend is your friend, it should keep going up. And I said I'm going to use advancing issues versus declining issues to give me a gauge as to whether or not that trend was strong. So I said, okay, I'll test it. And I had data going back to, let's see, it was 1997. I had data going back to 78, so I had about 20 years worth of data. And sure enough, I was pleasantly surprised at the result. If you turn to page 28 in your manual, here we go. What this chart shows, I don't know how well you can read it in your manual. I got some additional data after the first test that I did back to 78. Got some additional data and found all the way back to 1965. So now we're dealing with about 40 years worth of data. What this shows is the accuracy with which, but the advancing issues versus declining issues, it's the accuracy that that indicator predicts the up or down movement of the S&P 500 the following day. And let me give you an example. Look at this chart here. This is a colorized version of the chart. Let's say that on Thursday, decliners beat advancers. All right? And then the next day on Friday, it reversed from decliners beating advancers to advancing issues beating declining issues. Everybody follow that? We would call that the first day of advancing issues beating declining issues. What this graph shows, so Friday's day one of advancing issues beating declining issues. What's the likelihood that the market will be up on Monday, day two? And here it is, it's 62%. All right? On Monday, advancing issues beat declining issues. You have 2 consecutive days of advancing issues beating declining issues. What's the likelihood the market will be up on Tuesday? 62%. If on Tuesday, advancing issues beat declining issues, that would be 3 consecutive days of advancers beating decliners. Everybody follow that? What's the likelihood it'll be up the next day? 64%. And 64, 60, 65, 65, 70, 67, 59, and then boom, 11 straight days of advancing issues beating declining issues, it drops to 45%. Everybody follow? That's what this graph means. This is the numerical interpretation of the graph. If advancing issues beat declining issues, there's about a 60% chance the market will be up the next day, based on 40 years of history. Now the graph below that shows what about declining issues beating advancers. And I'll give you an example. On Thursday, on the OEX, or the NYSE, on Thursday, Thursday, advancing issues beat decliners. But on Friday, it reversed. So Thursday, advancers beat decliners. Friday, decliners beat advancers. So we have 1 consecutive day of decliners beating advancers. What's the likelihood that the market will be down on Monday? If history follows, 59%. If it continues down, if decliners beat advancers on Monday, there's again a 59% chance market will be down on Tuesday, and so on and so forth. So this gives us an idea of what we would call the persistence of the trend, which is about 60%. So that's the data. This helps us, and so I see that and I say, ooh, there's a market with opportunity. Well, now, what do you do with it? And here's what we do with it. It's so simple. It is so short term and so accurate that you can trade options off the signal. Now here's what's interesting, because this is what we've done different. If you trade OEX options, be sure to use the New York Stock Exchange advanced decline data. Well, where can you get that? We've got it on our website. It's right there. It has ADV and DECL right on our website. But this is what's different that we've changed. We've tested this using QQQ options. If people know what you all know what the QQQ is, right? It's the NASDAQ Index Trust, the NASDAQ 100. They take the NASDAQ 100 and divide it by 40, and that's the QQQ value. You can trade QQQ options, but you need to be sure you use the NASDAQ Advanced Decline. Again, on our website, we give a link to that. It takes you to dbc.com. So just go to our website, click on the link, and it takes you to the NASDAQ Advanced Decline. So there's the market with opportunity. If advancers beat decliners, we want to be bullish on the OEX or bullish on the QQQ. So then the question is, there's the opportunity. What's the right strategy? What's the right entry? What's the right exit? The strategy is to buy a front month at the money index option on the signal. So front month, what month would that be right now? December, exactly. Now what happens, remember that parabolic curve? I told you you wouldn't need to know the math, but you need to know the concept. That last 2 weeks is a death dive. So we cannot buy front month options in the last 2 weeks, especially if you buy a call and you hold it for 11 days because the trend is your friend. Well, you don't want to be in that period where you're getting the death dive, right? Because you'll have a friendly trend, but a very unfriendly time decay. So that's why basically sometime in the beginning of December, 2.5 weeks before the at-the-money options or the December options expire, we would start to the Januaries. Okay? If you're bullish, and let's just say on Monday we get a signal to buy a call. If you're bullish, you buy a call and you hold it. If on Tuesday you get another bullish signal, just hold on to your call. Don't add to it. Everybody follow that? So if that's the case, if advancers beat decliners, you buy a call. If it reverses course, where decliners beat advancers, what do you think you would do? Sell your call. There's your exit strategy. And then do what? Buy a put. There it is. Like I said, it's really simple. 2 numbers. So now we have our exit strategy. We know what strategy to buy. Buy an at-the-money front-month option. At the money, what does that mean? Remember that? What does that mean? Anybody want to take a shot? The stock price closest to the strike price, or the strike price closest to the stock price. So if the QQQ is right around 39 right now, so what would our strike price be? Actually, it's 39. Because the QQQ, those options are in $1 increments. Now, OEX is pretty interesting. They just started this with this expiration. The December options had them listed 10 points wide. So the OEX was at 559. A couple days ago, it was at 565. So you either had to choose the 560 or the 570. Whichever was closest. So if it was 565.01, I'd choose the 570. And 564.99, I'd choose the 560. And if it's 565, then I flip a coin. But just choose whichever one's the closest. Everybody follow that? So now we've got just about everything we need. We've got the market with opportunity. It's either going to be the QQQ or the OEX. We've got the strategy. If it's bullish, buy a call. If it's bearish, buy a put. Which put do we buy? The at-the-money front month. Unless it's 2.5 weeks before expiration, then we go to the subsequent month. So we got the strategy, and we have the exit strategy. And the only thing left to answer then is what's the right entry price? And we're going to make it real simple. At the market. Just real simple. Everybody follow that? And that's it. That is it.